Welcome to vTalkInsight, Market Drivers Daily for May 25th, 2026. Geopolitics around the Strait of Hormuz, shifting interest rate expectations, and an AI-driven growth gap between the U.S. and Europe are all moving prices today. Let's start with how the apparent easing in energy risks is feeding through to risk assets and the broader macro picture. Energy and geopolitics remain the main macro anchor, but the tone has shifted toward cautious optimism. Progress in talks between the U.S. and Iran over reopening the Strait of Hormuz has pushed Brent crude down roughly 4 to 6%, with prices dipping below $100 for the first time since late April. Global equities are trading near record highs, and European equity futures are up close to 1%, as markets embrace the idea that a deal could gradually restore oil flows and reduce the tail risk of a wider conflict. Beneath the headline optimism, the physical picture is still tight. Officials signal progress toward an agreement, including talk of a temporary ceasefire and a phased reopening of the strait. Yet both Washington and Tehran acknowledge unresolved issues and no formal deal is signed. Some vessel traffic, including oil and liquefied natural gas tankers, has increased, signaling a partial easing of disruptions, but flows remain well below pre-war levels, and analysts do not expect full capacity before around 2027 because of backlogs, deepening, and infrastructure repairs. Energy prices are therefore expected to ease gradually from early summer if diplomacy holds, but not to return to pre-conflict levels given the persistent risk premium. The immediate market reaction has been a classic risk on rotation, especially in Europe. European equities are rallying, led by cyclicals such as autos, construction, travel, leisure, and tech, while airline stocks globally are bouncing on relief that jet fuel shortages may prove less severe if the strait reopens. European government bonds are also in demand, with yields falling a few basis points across Germany, France, and Greece, as rate-sensitive assets benefit from lower oil and hopes of de-escalation. Yet Europe remains structurally vulnerable as a large energy importer, with growth close to zero and inflation still elevated, and is accelerating a shift towards small modular nuclear reactors to improve long-term supply security. Among emerging markets, Turkey stands out as especially exposed to any renewed energy shock. The country's large energy import bill means that every $10 increase in oil prices is estimated to add more than 1 percentage point to inflation and worsen the current account deficit by several billion dollars, even as political turmoil and talk of early elections keep domestic risk elevated. At the same time, flight cancellations and tighter screening linked to the Ebola outbreak highlight that non-energy shocks can still disrupt travel and trade, partly offsetting the benefit from cheaper fuel. Past attempts at U.S. Iran de-escalation have failed to deliver lasting change, and recent commentary from both sides has already tempered earlier optimism, so oil volatility and headline risk for energy and transport sectors remain high. Watch near-term developments in the negotiations, actual shipping volumes through the strait, and domestic politics in fragile importers like Turkey, as these will strongly influence how durable today's risk on move really is and how central banks react to changing energy conditions. The rates story today is about how a tentative easing in energy stress interacts with an entrenched higher for longer backdrop. Rising real yields in global bond markets reflect not only persistent inflation worries, but also growing anxiety over sovereign deficits and debt loads, keeping term premia elevated and capping how far long-term yields can fall. In the U.S., upcoming core PCE inflation data and the swearing in of a new Federal Reserve chair this week are key catalysts for front-end pricing, especially with the economy still projected to grow around 2% this year and next on the back of strong consumers, expansionary fiscal policy, and an AI-driven capital expenditure boom. Europe faces a more uncomfortable mix of weak growth and sticky prices. Headline inflation in the euro area has risen to about 3%, above the European Central Bank's 2% target, and the ECB is widely expected to lift its inflation forecasts and deliver a June rate hike, with inflation seen averaging around 3.5% in the second half of the year. Markets increasingly view that move as potentially a one-off, helped by lower oil, but if Middle East conflict drags on and energy prices stay elevated, the ECB could be pushed toward more restrictive territory above 3%, even as Eurozone growth lingers near zero. That raises the risk of a policy mistake and a stagflationary outcome, particularly given concerns over Germany's auto sector, sluggish French consumption, and Europe's structural vulnerability to energy and shipping shocks. Policy divergence is even more striking when looking at Japan, the UK, and key emerging markets. Japanese government bond yields remain very low relative to ongoing inflation, and policy rates are far below the roughly 2.8 to 3% level implied by simple rules, leaving the Bank of Japan clearly behind the curve even as it stays in gradual normalization mode. The yen has become a barometer of policy credibility. Any disappointment on the pace of rate hikes risks further currency weakness and additional imported inflation, while a durable resolution in the Middle East and lower oil prices could give the bank more room to tighten without choking off growth. In the UK, markets now see at most a single Bank of England hike, or potentially none, this year, and long-dated gilts are attracting interest at current yields even though near-term performance is clouded by domestic political uncertainty. For energy importing emerging markets like Turkey, central banks are reluctant to tighten unless political turmoil or a sustained spike in Gulf-driven oil prices forces their hand, leaving them highly sensitive to any renewed move higher in crude. Putting these strands together, the base case still points to yield curves that adjust only slowly. If geopolitical tensions in energy continue to ease, front-end yields may fall more quickly as central banks gain confidence that headline inflation will drift lower, but long-term yields are unlikely to decline sharply in the near term because of entrenched inflation, heavy fiscal needs, and elevated risk premia. A medium to long-term weakening of the U.S. dollar is expected unless the Federal Reserve resumes rate hikes, which would reduce the dollar's centrality in global portfolio allocations and potentially rebalance flows toward other currencies. The counter-argument is that lower energy prices from early summer, combined with eventual productivity gains from AI adoption, could bring inflation down faster than feared and allow a more decisive shift away from higher for longer pricing. For now, the focus stays on the next U.S. core PCE print. Early communication from the new Fed chair, the ECB's June decision, and signals from the Bank of Japan and sensitive currencies like the yen, all of which will frame how durable today's rates regime is as the AI growth story unfolds. The AI theme remains central to the macro narrative, but with a sharper focus on divergence and real-world execution. In the U.S., the economy is projected to grow around 2% this year and next, supported by healthy consumers, expansionary fiscal policy, and an AI-led investment cycle that is driving large data center and infrastructure spending. Europe, by contrast, is facing sub-1% growth this year as energy import dependency and geopolitical shocks weigh on activity, with only a modest recovery expected next year, widening the economic and earnings gap with the U.S. While Europe currently lags in AI investment, more widespread adoption and supportive policy could gradually lift productivity over the next 2 to 3 years, providing some resilience to an otherwise weak growth profile. Inside companies, especially in finance, AI is driving a complex mix of ambition and anxiety. Employers and employees increasingly expect significant workforce disruption, with concerns that job losses and efficiency gains will be concentrated among large firms and shareholders rather than broadly shared. Surveys highlight a major gap between executives who anticipate strong productivity gains from AI and workers who report only limited improvements in their day-to-day tasks so far, suggesting that many corporate leaders may be overestimating near-term efficiency benefits. Management teams also face growing pressure from boards and investors to roll out AI quickly, which often leads to superficial deployments rather than deep organizational redesign, limiting the value realized from the investment. Public unease is rising too, with a significant share of people fearing civil unrest if AI-driven job displacement happens too fast and the benefits remain unevenly distributed, making social and political reaction an increasingly important risk factor for AI-exposed sectors. One area where AI's impact is more tangible is healthcare and scientific research. In drug discovery, AI is compressing timelines so that teams can move from model insight to a viable molecule within months, dramatically improving the speed and potential success rate of new therapies. AI-driven diagnostics are enabling early cancer detection from blood tests and more precise matching of patients to treatments, raising both the effectiveness and efficiency of care. At the same time, GLP-1 medicines are seeing rapid take-up in the U.S., with many consumers willing to pay out of pocket, signaling a structural shift in chronic disease management and preventative care. AI-native healthcare companies are expected to outperform more traditional peers as outcomes increasingly depend on advanced data-driven approaches, and the convergence of AI as a trusted patient interface with the GLP-1 revolution is creating new, potentially lucrative models centered on prevention and long-term wellness. The semiconductor supply chain is another crucial front in the AI story, with clear geopolitical overtones. Chinese foundries are reportedly narrowing the technology gap with global leaders even without access to ASML's most advanced lithography tools, while ASML continues to ship older deep ultraviolet machines to China, preserving a significant revenue stream. The industry is watching closely whether companies like Huawei and SMIC can deliver advanced chips at both quality and scale under these constraints. Success would reduce Western leverage over AI hardware supply and accelerate the rewiring of global semiconductor trade. Looking ahead, scaling laws and so-called scientific intelligence suggest that core AI capabilities will increasingly become a commodity, empowering scientists worldwide to tackle complex problems faster and with lower capital requirements, but potentially compressing moats for some incumbent AI leaders. The key watch points are how quickly firms move from pilot projects to measurable productivity gains, how policymakers respond to labor and security concerns, and whether Europe and China can close parts of the AI and semiconductor gap with the U.S. without triggering new rounds of trade and technology tensions. To sum up, energy diplomacy around the Strait of Hormuz is easing some of the immediate pressure on oil and supporting a risk-on tone, but shipping bottlenecks and structural vulnerabilities in regions like Europe and Turkey mean the energy shock story is not over. Rates markets remain anchored by higher for longer dynamics, with front end sensitive to the next U.S. core PCE print and new Fed leadership, while long-term yields stay elevated as inflation and fiscal concerns persist, and central bank from the ECB to the Bank of Japan navigate very different starting points. On growth, AI continues to underpin U.S. outperformance and drive powerful change in healthcare and scientific innovation, even as gaps between executive expectations, workforce experience, and public acceptance introduce new execution and political risks. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.